everyone, I'm Professor Harrison, and welcome back to Introduction to Finance. Today we're figuring out where a company's cash actually went. The bank account grew this year, and we're going to explain every single dollar of that change. The income statement tells you exactly what a company earned. Unfortunately, that's a little bit different from the cash the company actually collected. Those are two different stories because profit gets booked when it's earned, not when the money actually shows up. So, if we want to figure out how the cash moved into and out of the company, we have to turn to the statement of cash flows, which sorts every dollar that moved into three buckets: where it came from and where it went, so that you can see what really happened to a company's cash. Let's take a look at our problem. We're going to be helping Tom, who owns an outdoor gear company. We have his company's balance sheets for 2023 and 2024 and the income statements for both years. Everything we need is sitting in these three tables, and our job is to build the 2024 statement of cash flows, operating, investing, and financing activities, and to confirm that it explains the change in the cash account. So before we even begin, let's think about what we're trying to figure out. We know that cash went from $1,000 up to $11,000 on the balance sheet. What we're trying to figure out is where that $10,000 change actually came from. If we start a statement of cash flows, the best place to start is by noting exactly how it's going to break this $10,000 change down. We're going to break it up into three sections: cash from operating activities, which is how the day to day operations generated cash from investing activities, which is how the cash ended up moving due to investments in long term assets, and then cash from financing activities, which is how the cash moved to and from the company's investors. The first piece that we're going to start with is cash from operating activities, the cash generated by day to day business. The standard approach is called the indirect method, which means we're going to start with net income and back out how cash actually moved, as opposed to starting with something like sales and working our way up to how cash moved. With net income, we started out at $24,375. Then the goal is to fix this because net income is a little bit different from how cash actually moved for a couple reasons that we'll see. The first fix that we have to make is depreciation. Depreciation reduced net income by $3,500, but the problem is that depreciation isn't actually a cash expense. In some sense, we just wrote it off to get a tax break, but the money never actually left our hands. It's just writing down the value of a machine or some sort of equipment that we said ended up decreasing in value despite the fact that we had no physical loss of cash. So we add this back to our net income to get a little bit closer to how our cash actually ended up moving due to our operations. The next thing we need to do is make adjustments for the changes in our current accounts. The idea is that these accounts change for a reason, and those reasons aren't necessarily reflected on the income statement, but they do affect the cash and they are a part of the day to day operations of the company, so they need to be accounted for in this section. Let's start with inventory, which fell by $2,000. If the inventory fell, that means Tom sold gear off the shelves without spending money to restock it. So the value that was sitting there as a product turned back into cash in the bank, which is a positive. Think about it this way. The $16,500 in cost of goods sold was effectively us writing off the cost of our inventory. But out of that $16,500, not all of it is actually cash that we spent during this period. Of it, the $2,000 that we got from the previous inventory was not cash that we just spent. The $14,500 was. That's exactly where this $2,000 comes from. Tom is just using the inventory that he already had instead of buying new inventory. And that's exactly why the inventory drops by $2,000. Let's think of the flip side. If inventory had increased instead, then that increase would end up reflecting Tom spending money to fill his shelves so that he can continue to make sales. And that would be actual cash leaving his hands, so it would need to be a decrease in the total amount of cash coming into the company. The next thing we're going to adjust is receivables, which fell by $3,000. A receivable is a sale that we already counted as income even though the customer hasn't paid it yet. So when the receivables fell, those customers finally handed over the cash. So that's going to be a cash inflow. Think about it this way. In this period, we had $55,000 worth of sales. However, we additionally collected another $3,000 worth of sales from the previous period. Because of that, we have an additional $3,000 that we need to adjust our net income by to get closer to the cash we actually received. In contrast, if receivables had risen, we would have booked income with no money attached, so the sales would have happened, but it wouldn't have been collected yet, so we would need to subtract the increase. Then let's move on to the payables. Accounts payable rose by $1,000 and wages payable rose by $4,000. Those are bills and paychecks that the company owes but hasn't paid yet. which means that the expense already hit net income while the cash never actually left. Because of that, both of them are going to be added. We effectively have written off these expenses already, but they haven't actually left our wallet. So we have to adjust our net income for this money that we haven't paid yet. In contrast, if either had fallen, then that would mean extra money is leaving your pocket and you would need to subtract it. One thing that we'll note is that one account here gets left out on purpose. Notes payable went up by $2,000, but that didn't happen because Tom ran the business. That happened because Tom borrowed money. And when he borrows money, he's effectively raising a new investor. That investor is giving him money, and in the future, he's going to pay it back plus some interest. That's exactly the type of stuff that we're going to put in the financing category instead of operations. And we'll see exactly how we deal with that when we get to it later. Next, we're going to add up the operating section, and we end up with $37,875. The day-to-day business generated quite a lot of cash this year. Now, before we move on, let me show you a second way to handle all those current accounts, because the four adjustments we just made are really one number: the change in non-cash net working capital. Non-cash net working capital is the non-cash current assets minus the spontaneous current liabilities, meaning we're taking the payables that arise from running the business, not the ones that have to do with external financing like notes payable. With this method, we don't have to sit and think about whether cash is going into or out of a company with each account. We can simply calculate two numbers, take their difference, and then subtract that difference, and it gives us the change in non-cash net working capital directly. Let's see how this works. In 2023, we want to calculate our non-cash net working capital. This is going to be our inventory of $3,000 plus receivables of $5,000, which gives us $8,000 in non-cash current assets. Then we're going to subtract off the accounts payable of $3,000 and wages payable of $1,000, noting that we're skipping over the notes payable. This gives us a non-cash net working capital of $4,000 in 2023. In 2024, we repeat this process. Inventory is $1,000 plus receivables of $2,000, which gives us $3,000. And we subtract off the payables of $4,000 and $5,000, and we end up with negative $6,000. Now all we have to do is take the difference between these two numbers and then subtract it, and that'll give us the exact same answer as it did when we went account by account. So we take our 2024 value of negative $6,000 and we subtract off our 2023 value minus $4,000, giving us a total amount of minus $10,000. So over the year, net working capital dropped by $10,000. A drop in net working capital means the business pulled cash out of its day-to-day accounts, so it enters as a plus sign. We subtract this negative $10,000, which is equivalent to an adding $10,000, and it makes it so that the total amount of cash coming into the company is higher. We'll note also that this $10,000 increase is the exact same thing we would have gotten if we had gone account by account, and it gives us the exact same answer. Both methods result in the exact same thing. The next section is cash from investing activities, and it's the money that's spent on long-term assets, so things like buying equipment, tractors, factories, those sorts of things. So our focus here is going to be only on the long-term assets side of the balance sheet. The account that we want to use here is gross plant property and equipment, not net. This is something that always confuses people. And the reason why we use gross over net has to do with the difference between the two. Gross PPE is what the company actually paid for its plant property and equipment, before any depreciation gets taken out. Where net PPE comes in is it's the value of that equipment today, so the after depreciation amount. Our idea is that we want to figure out what the company actually paid, not what the new equipment is worth, which is exactly why we use gross PPE and not net. So in our example, gross PPE went from $20,000 up to $35,000. So the company spent $15,000 on new plant property and equipment. Similarly, our intangible assets went from $2,000 up to $5,000. So there's another $3,000 there. And although these assets are intangible, they're actually something that the company is spending money on. So that's real money leaving the company's hands. Usually intangibles have to do with things like patents or trademarks that the company is acquiring from someone else. So that's actually money leaving, and it's something we have to keep track of in this section. That's a massive investment for a company of this size, and every dollar of it is cash going out. So cash from investing activities comes out at negative $18,000. The last section is cash from financing activities. This is the section where we keep track of how money flows to and from investors. This is where borrowing is, it's where stock is, and it's also where things like dividends are paid out. Here we're going to start with notes payable. You'll remember how during the operating section of the statement, we did not use notes payable. The reason is because it's a source of external financing. So here, if our notes payable goes up by $2,000, then that means there's an extra $2,000 that has been brought into the company in the form of a loan. Similarly, if long-term debt goes up, then that means that $15,000 were brought into the company in the form of long-term debt. You can think of the flip side of these as paying off your obligations. If long-term debt goes down, then that means that you paid something off, and it would be a cash outflow, so it would get subtracted. Same thing with notes payable. Next, let's think about what happens with common stock. Here, our common stock fell from $4,000 down to $1,000. This means that the company bought back $3,000 of its own stock. Effectively, what happens is that's cash in exchange for shares. The cash is leaving the company's hands, and the shares become the company's, making it so that the company has less cash on hand, so we have to subtract it. The flip side of this would be issuing stock, in which case, stock would be sold onto the open market and the company would receive cash in exchange. Then finally, the last thing we need to keep track of is dividends. One thing that confuses people is that on the income statement, dividends are given to you as a rolling number, not as a cumulative number. It's not the total amount of dividends paid up until that point, it's the amount of dividends that were paid in that year. So in our example, the company paid $23,875 in dividends. This is also going to be money going out, so we need to subtract it from our financing activities cash flow. Once we sum these things up, cash from financing activities is negative $9,875. Now that we've calculated the cash flows across our three different sources, we can check whether our answer is correct. We can take each one and add them up, and we should get the exact $10,000 that our cash changed by. Let's check this out. Operating gave us $37,875, investing took $18,000, and financing took $9,875. If we net these out, we get exactly the $10,000 change in cash that was our real change in cash from the last period to this one. So we know our statement must be correct. Every dollar has been accounted for, and we've now divided them up across three different sections so we can see exactly how the cash is moving into and out of the company. That's the purpose of the statement of cash flows. So what exactly did we learn today? We learned how to build a statement of cash flows. The statement sorts every source and use of cash into three buckets. Operating is the cash from running the business. Investing is the cash spent on long-term assets, and financing is how the cash moved between the company and its investors. Once we solve for all three sources of cash, we can exactly calculate where the cash flow came from the last year.